All right, let's get rolling here. I got our 40 minutes to go. A little bit about myself. Been doing it a long time. This is a picture of myself over 20 years ago. First Trader Expo ever that occurred. I think it was back 1999. Anyway, that was me in the middle there. And the booth that we had, training, trading, and technology. This was the old company, Pristine. Master Trader back in the day was a brokerage firm, one of the first online brokerage firms that was available to individual traders. And just did a fax service for back 1994, that stuff that came out on the thermal paper. If you used such things back then, and did, the hotels, eventually recorded seminars, sold all of that stuff back in 2015. At those trading expos, I used to do live trading challenges with real money. It was lots of fun. I used to bring, lots of big crowds, and it was, like I said, a lot of fun. Over the years, I've educated, I don't know, thousands, tens of thousands. You figure over 25 years or so. Hedge fund managers, specialists, market makers, and was an interesting learning process for myself, meeting those types of people, because as someone not, I guess, born into the market per se, you think that those people are all knowing, they got inside information. Most of them, all they know is order flow, and what information can be fed to them from some news source, but knew little to nothing about technical analysis, which I'm going to share with you. And of course, taught a lot of prop traders and so on. And a lot of my students today are actually in the education business or the prop trading business, and a lot of well-knowns. You can go to my website, and there's a whole list, partial list there of some of them. So what I teach is a lot of the basic stuff, price analysis and trend analysis. Is it going up, down, or sideways? Support, resistance, multiple time frames is a big one. How to put that all together. It's really an art in of itself, and understanding how to put that together. But I'm going to simplify that for you with some pretty basic stuff. Everything I do really is basic, and what I like to refer to as common sense, and removing the noise. Relative strength and weakness, retracements, bar by bar analysis is something I came up with many years ago. And it started out as a way of controlling my emotions of that fear and greed. Things are going up. Well, the last trade didn't work. I better sell before this one goes bad. Well, based on what? Look at that individual bar. Is there anything there that is suggest anything that's going to go against you? If not, hold on. Be objective. That's a big word for me. Being objective about what's there versus what you're thinking. Right? Think what the market tells you to think. Having a bias based on trends and market internals. Right? Market internals was a big one too, because as I looked at a lot of trades, it's like, why did this one work? Why didn't that one work? And so what's happening in the markets can affect the majority of stocks. Market internals right now are saying danger. Historically, this market's getting ready for some kind of a pullback. Seasonally, we're into a bullish period in time. So there's this conflict there. So the markets are a little, wacky at this point, where these different tugs are going on. And money management is truly the key to success here. It's so tied to your psychology, which everyone agrees psychology is such a big part of being a successful trader based on technicals. Well, some of you might think there's something wrong with you after a while, where maybe it's just not. You just need some education. But money management is a major key, because even if you are following your plan, once you have one, without proper money management, you're going to have these psychological demons about fear. If the position is too big, or I'm not making enough money, or believe me, it's a major part of being successful. And most people are not successful at this because they start out without any money management, even though they maybe know a little bit about candlesticks and turning points. So as time went on, right? And trying to figure out the market. Why did things work? And I go through the same stuff most of you probably are right now. But I come up with this theme of once the light bulb went on for me as to objective information and subjective information. And well, objective is based on facts. These are definitions. Right? I can't manipulate that. Whereas subjective things are based on opinions, judgments, feelings, and things that I can change. Well, when I look at the chart, depending on what I put on that chart, is going to create my reality about what I believe is going to happen. So I have to base that on objective information and understand it. Now, when you open up your trading platform, which is very exciting at the beginning when you're getting started, and this is, I think, from my platform, one of the platforms I use is eSignal. The other one is NinjaTrader. Just a choice about charting and how I want to use them. But I think this one is from eSignal, and it's got all of these indicators on there. I was like, which one? There's 68 of them here, and there's more. I can create my own. What combination and which settings? It's pretty confusing. So this is your typical thing that you might see, stochastics and MACDs, and you get into the same questions, which settings, which indicators. You hear words like optimized and modified, and then you start asking yourself these kind of questions as to, well, it's overbought, right? That means it's not supposed to go up, and how the heck is it going up? Or oversold, how does it continue to go down? And then you start drawing these lines where you connect dots and project them into the future. And somehow mysteriously, that is supposed to create support or resistance at some place in the future, or the break of one of these lines violates the trends. And then you see it doesn't work. And the questions evolve because it must be you, because everyone else is using this stuff. So it's got to be you that you picked the wrong ones, or you're not using them right. So all that conflict comes in about, what you're doing wrong, and on to the next webinar, and someone's going to sell you the optimal indicator. And of course, changing time frames, all of this changes this, overbought and oversold. It becomes a real rabbit hole. So as you draw these lines, how many times can you redraw it, see it break, and resume the trend, and not be thinking, what goes on here? I'm doing this wrong. And you see this on CNBC where they connect the dots and they draw their finger across the screen. Well, do they ever come back and say, hey, the line broke, but it didn't work, and explain why? Of course not. They redraw the line. Now it's in a different place. And all of this more confusing. And if you've been at this for any length of time, you know what I'm talking about, and your head is spinning and you're looking for the truth, and I'm going to show you. Right? So there's all these flavors of how you want to draw lines and connect these dots: pitchforks, speed lines, and Fibonacci lines, Gann lines, Elliott waves, and then we can get into VWAP, right? And time cycles. It's really insanity. And you keep doing it, you keep making tweaks to it, you keep questioning it, and that's the definition of insanity: doing the same thing over and over again and expecting different results. So the answer is not in all of these tools that I'll call them tools that you're told that you're supposed to be using to figure out support and resistance and breaks of trends and so on. If there was, there'd be one, and that's all that would be used. Then we come to what I'll just call the ultimate indicator that's supposed to do everything. This kind of thing wasn't around when I started way back in the day. I guess I got lucky. But you come to the same conclusions as to settings and why does it work, why doesn't it work, how does it mysteriously, find turning points, and it doesn't. It's just something somebody came up with, probably a really intelligent guy. They sell courses on this stuff, and it just It's craziness. You got to be ready to listen to something different, and you probably are if you're here. So how I do it? Well, I look at pictures. Pictures communicate to me what other people are doing with their money. It communicates to me what they believe, what their expectations are. Right? That's what technical analysis is. Price patterns that tell us what other traders have done, what do they expect within the time frame that we're looking at. Now, if I can align multiple time frames, the way I look at it is I'm aligning more and more traders with the same belief. Excuse me. Right? Because now all of these multiple time frames are coming together. So the more people that believe the same thing, that are going in the same direction, the greater the probability of continuing that direction. Now I have to find an entry point to get on board. And the candles, I like to call candle language, they speak to me about this. Well, let's continue to simplify that. So there are books written on candlesticks. Obviously, of course, you know that. Maybe you've read a few. And they have all of these different names as to what you call these patterns. And what I came to realize is none of that matters as to the names of these. The thing to understand is how it's moving up or down. It's about retracements. So whether it's this 3-bar combination, which might have a name like a morning star, or a 2-bar, which could be an engulfing pattern or piercing patterns or shooting stars, you can forget all of that. It went down and it went back up. So depending on the time frame you're looking at, well, you might look at the bottoming tail, as I'll call it, the one on the left. The one in the middle, I'd call a 180 reversal. And the one on the end, it went down and it went back up again, and it stalled in between. Right? So understanding that takes out the mystery of these different names. So we have different patterns. I like to use these 4 foundational patterns. The further I can narrow things down, the easier it is to make decisions. Simplification. So there are retracement patterns. So within an uptrend, prices retrace back to an area called support or in resistance, in a downtrend into resistance, and we look for candlesticks that went up and went back down, or went down and they came back up. Retest patterns. It's a little bit more information that takes more time to develop. And I like these a lot because that extra time, gets me to see more traders that are getting involved in that particular stock, and it's creating a little consolidation over time. I'll just get a little drawing thing out here. All right, so you can see as it pulls back and then you get a retest. So more traders step on board here and form that reversal, and they tend to have a higher probability of continuing in a move up. If this was coming down within an uptrend, of course, these can come down within downtrends. And where this forms, the location is going to be key as to the probability of it moving back up. Flag patterns. Right? So they got these flags, these pendants as they're called. And what they are doing is the initial move up is a momentum move, a power move. And the flag is a point in time where it creates an area of support in a bullish one where it's gone up. And where it's gone down, it kind of grinds up and it creates resistance because the momentum move creates what I'll call a void of support on a move up and a void of resistance with the move down. So the flag pattern develops over time where traders are willing to step up and create that support or resistance where there is none. And that tends to be a continuation pattern, a type of continuation pattern. And then there's the base, where we all love to buy breakouts in an uptrend and sell breakdowns within a downtrend, because if it's developed a base in an uptrend, it's creating an area of support, and breakouts should work, and vice versa. So depending on the time frame you want to utilize, what we'll call swing trading, which we're going to trade from daily and weekly charts. And we're expecting moves usually from a couple of days to a couple of weeks. And we use the weekly time frame, what we call our macro time frame, and our big picture. And our daily time frame we'll call a micro time frame, where we're going to find entry points in alignment with our higher time frame. And for day trading, there are choices here, lots of choices as to the time frames that you want to use. So I use a 60-minute chart for my macro time frame for day trading, and I use a 5-minute chart for my micro time frame for my entry points that are in alignment with the 60. Now, sometimes those momentum moves are so fast that I don't get a pattern on the 5, but so I may have been left behind, and at those times I'll drop down to a 2-minute if I need to find that picture that tells me it's time to get on board. So the analysis is the same through all of these time frames. The implications are different. So from a swing trading point of view, where I'd be looking for something to happen over several days or a couple of weeks, well, on an intraday time frame, I'm looking for something to happen over a course usually of an hour or two. Sometimes it's an all-day type of trade. But those micro time frames, especially the 5-minute, you'll find are really not only useless, but detrimental to you as a swing trader. You'll give up a lot of trades that based on you'll get scared out of them because of the smaller time frame that really don't mean much. So as you look at this, it's kind of simplifying with these just lines where the light blue line is just sloped up. We'll call it our macro time frame, which says, hey, this is going up. I think it's going to continue to go up because there's nothing to the left. There's no resistance. So in that macro time frame, I'm looking to buy pullbacks. I'm looking to buy flag patterns. I'm looking to buy retest patterns. I'm looking to buy breakouts. Any of those can form depending on what's happening at that time. So as it pulls back and these time frames, these pictures are in alignment with each other, I can get on board, which should continue to move to the upside. And if it was going down, we just flip it upside down and we change our bias. And I think it's going to go down because of the macro time frame, and I find my pictures on the micro time frame and look for continuation. So here's where you're going to get a little subjective, but we're going to make this information very objective with the use of some simple moving averages. What we're going to pay attention to, these as a visual aid, is the distance, slope, and position of those moving averages and the moving averages to price. Because as prices pick up momentum, they move away from the moving averages. And as momentum slows down, the moving averages catch up to prices. And we can help us interpret or speed up what our thought process is. So these moving averages are not what I'll call actual support or resistance. A lot of people have referred to the 50 MA as support or the 200 MA as being stronger support. Nothing could be further from the truth. They can become a self-fulfilling prophecy. Because if enough people are looking at the same thing with a similar belief, they will act on that belief and create a pattern, right? Pull back to the 200, institutions are going to be there, or the 50. And so they'll act, and then we can see if they form one of those patterns. And now we can use these moving averages to understand what's happening in multiple time frames by just looking at one time frame. Let me show you. So pretty simple, but it's really what I would call a more intelligent way of using moving averages, because they're giving us much more useful information. So here are examples of what we're going to do. So the 10 MA is the same as a 50 MA. Right? A 10 MA on a weekly is the same as a 50 MA on a daily. We take, how many bars does it take to make a daily bar into a weekly? 1. Right? So 5 bars times a 10 MA equals the 50 MA, which we would put on our daily time frame. And now we know if the 50 MA is rising, the weekly time frame is going up. If it's going down, the weekly's going down. If it's flat and going sideways, obviously the weekly's going flat and sideways. So I'll get my bias from that. Monthly 10 MA is the same as a 200 on the daily. you can see the calculation. 20, the same as the 100, right? The 20 MA on the weekly, same as the 100 on the daily. There's the calculation. So on my daily chart, I'm going to put on a 20, a 50, and a 200 period moving average. And now I've gained a bias by the general direction, not the pattern, but the direction of what's happening on the daily time frame, the weekly time frame, and the monthly time frame. Are they all going up? Are they all going down? Are some going up, some going sideways? We could tell that by looking at one chart. And so on the left, you see the cues there, the three moving averages, and at one point they were all facing up. That tells me my bias is to buy pullbacks, buy breakouts, buy retest patterns, buy flag patterns, look for that to continue. Now, as prices get extended from those moving averages, as you see that they did in the middle of the chart there in August, they ran straight up. Well, the increased probability of they're going to pull back. So I'm not buying up there because there's no pattern, but I know the probability is that it's likely to start pulling back. You see the cues there on the weekly with the 20 MA and on the monthly, the 10 MA. I mean, they're not going to be exactly in the same place, but we're not looking for exactness here. We're looking for to see the direction and be real close. So when I'm looking at the daily and prices break down under, and that PL means pivot low, right? And that pivot low is simply a bar with three higher low bars to the left and right, and a pivot high is three lower high bars to the left and right. And the trend of those pivots, right, is it continuing to make higher highs and higher lows or not? And more simple analysis. So as we look at this chart, I'm going to say, what's the distance, slope, and position? How far are prices from the 20, the 50, or the 100? Is it getting extended? Are prices next to the moving averages? Are they pulling back? You see there in July, as it pulled back toward the 50, there was a little violation of the trend. The weekly was still up, and it recovered, and it went back up again. So on the end of the chart where the red circle is, we see that prices had a deep pullback into the moving averages. The monthly was still up because it's well above the 200. And that's what I call it's beginning to repair the damage at that point. Over here where you got extended and it broke down, it violated the trend by trading under that pivot low. It broke the 50, so now the institutions are getting nervous. Right? It might have come down to the 200, and now we see the candles, gap reversal, retest pattern, and so on. And now we've got this bullish price action over here. So this breakdown, now where it looked like it was going to go lower, now it's not. And see, this is what I call the red bar ignored right there. And so now this looks like it should be able to continue to move up toward the old high. So we have to make some assumptions based on the price action, and we have to have objective information that allows us to change our opinions. An example of a downtrend, right? And you see on the left side there, things were just collapsing to the downside. And there's really no continuation pattern there. And this would be a time where, unless we got in on the breakdown, and you could see the break under the green bar, and we should assume that this is a possibility. Why? Look at the moving averages. They're pointing down. So the green bar here is actually something that should not follow through. Now I'm going to wait and see if it doesn't, but a break under there would be a good short entry point. And surprisingly, it didn't retrace at all. Now, here's a bottoming pattern, and it gets above the 20 and the 50, and a lot of traders get attracted to these because they think, well, it's cheap. Well, yeah, it's a lot cheaper than it was here, granted, but these tend to be treacherous patterns, meaning they look fantastic and they fall apart, and it takes time, and usually sometimes months, to really get washed out or build a strong enough base. And this doesn't surprise me when it, breaks down again. But these tend to be real good for credit spreads if you're interested in that type of a vehicle. These bottoming patterns where we can call a low for several days or a week or two at the most, and collect some premium. So they're really good for credit spreads. But you see how wide the moving averages were here? You see how tight they get again over here? Greater probability of that continuing. All right. I know I'm going a little fast, folks, but I'm trying to cover a lot here in a short amount of time. This is one of the thousands and thousands of testimonials that I've gotten over the years, and we get them every day. And a lot of them revolve around what I'm telling you. People getting away from what I'll call the holy grail, hocus pocus analysis, indicator-based methodology of trend lines, oscillators, VWAPs, whatever, Fibonacci. And when they realize it's about price action, they get those aha moments, and the simplicity of it is just, I don't know, it's just, you're just amazed by it, because we've all, and I didn't sidestep all of that craziness, but when you realize that you don't need it, it's freeing to take that stuff off of your chart, and the simplicity of what we do. Is it going up, down, or sideways? If it's forming a pattern, is it a bottoming pattern? Is it at support? And so on. Is it multiple time frames in alignment? So here's a power move higher. It creates that void concept. But going sideways like this creates this support. And so breakouts tend to work. Right? Sometimes they fail. This little continuation breakout failed. So I don't remember this chart, but surprised because of the gap down and reversal here, but it failed for whatever reason. And when that happens, it's a shock. And short-term traders, even short-term institutions, hit the bid. They drive it down. And it comes to the next point. You look to the left, where buyers feel comfortable stepping up again. And you then look for the price patterns. Gap down reversal, gap down reversal. And now bullish price action. Right? Red bar ignored. Bottoming tail bar that broke the low, and so on. So we put together bar by bar analysis with trend analysis, multiple time frame analysis. And what's to the left? It works. It's simple, works. It isn't confusing. Another example, a power move up, and here's the gap. It's bottoming. You can see the moving averages down here. You know that it's been going through a bottoming process because the moving averages are flat and they're starting to turn up. This is bottoming price action. It takes time. Red bars ignored. This is good for credit spreads. Selling credit spreads is that prices won't go down in a short amount of time. Right? And now this little buy pattern right here as it clears the highs. See that little bar right there? That's like a key thing for me because it broke the low. That's a continuation pattern. And here going sideways again. This creates a void. And here's your retest pattern right here. And it becomes what I call factory work. It's doing the same thing over and over again. And I went too far. Yeah, it's just an example. And my computer's getting a little wacky here. It's not about moving average crossovers. This, case indicator-based methodology where, it just leads you to more thoughts of which moving averages cross over, which ones, some too fast, some are too slow, simple, exponential. It's crazy, right? It's about breaking down and continuation patterns and creating support and resistance and so on. So let's get to the intraday part. We're going to do the same thing. I'm going to use my 5-minute chart, and I want to have a bias and of what's happening from multiple time frames. So there's the calculations I'll use the 200 MA. It's actually would be a 240, which would be the same as the 20 on the 60. I'm just going to use the 200 because it's easier, not easier, but it's more common. So I just decided to use the 200 instead of the 240. The 60 is the same as the 20 on the 15 minute, and then the 20 MA on the 5 minute. So what I'm looking for as intraday trades, for longs, I want prices to be above the opening price. I want prices to be above yesterday's close. I want prices to be above the moving averages. And now I look for patterns, continuation patterns, pullback patterns, flag patterns, breakouts, and so on. So I've got a bias based on that picture that I'm showing you right here. That's a starting point. I can do a scan and say, show me stocks that are above those moving averages. Don't tell me how much. Show me the ones that are above today's open and yesterday's close. And I want to look at those 5-minute charts. So now here's one that was going sideways. I mean, down. It was going down. It was going sideways initially. And then as it breaks down, and I'm not showing you the prices, obviously, but what we're looking for here, this is an afternoon trade that I look for on a daily basis, where something was weak, in this example, weak, going down. And after 2 o'clock, the 20 and the 60 begin to come together. And usually it's right over the top of prices, or prices are in between, and we just look for it to continue to go lower. If this was facing up, you look for it to continue to go up because you've got multiple time frames going in the same direction. No holy grail, right? Pretty simple stuff. It's just when you put it together, it's about putting together this information that puts the odds in your favor. So the daily chart, always looking at the daily chart. I'll trade against the daily chart as an intraday trader. But if I got the daily with a big picture pattern, which we have here, you see as it was rolling over, and then the 5-minute is going down. Well, you see right there at 2 o'clock, that's a perfect example of what I'm looking for, where the moving averages come together and they're pointing down. Just, it couldn't go up, so it went down. And so while it was going sideways, who's ever accumulating at that point, I guess, they're looking for it to bounce, and that's fine. Sometimes it does, but when it doesn't, after 2 o'clock, usually 2:15, it tends to go down. That's an example of an uptrend around 2 o'clock, a retest pattern right there above the purple line, which is, again, the 20 on the 15-minute. It's a 60-minute on the 5, but it's equal to the 20 on the 15. And when it pulls back to that prior low, I know there's going to be buyers there. So I just wait to see if they actually show up and form a reversal. And if they do, I'm going to assume, right? Now, this is an assumption. You're saying, well, how can you assume that, Greg? I'm going to assume it's going to take this out. People often ask, why'd you buy it here when there is resistance? Because the big picture says it should work. Does it always? Most of the time, not always. But that's some of the things we have to make assumptions about based on our analysis, because we really never know 100%. Another example, multiple time frames in alignment, same patterns. I mean, there's some different stuff here. Right to the left there where it says 15-minute trend up, right to the left on the purple line, it broke down and it recovered and it starts moving back up again. The takeaway here is looking at this 5-minute chart, you know what's happening in multiple time frames. That tells you what to think. It should continue going up. If it gets extended from the moving averages, well, now you think, wait for the pullback, wait for the base, wait for the flag. Now, I wanted to show you what I'll refer to as just being a mess. Stay away. It was going down on the left side of the chart. And so you might find continuation patterns. Now, this right here, this happens a lot. Now, you can see this is overnight, but this happens in the middle of the day too. Something extended like this, if you short that little base and it comes right back in your face, get out of the way, because other traders got caught too. And they're going to take the offer, and that tends to drive it up. These overlapping bars, just don't even bother. Stay away from it. This wild stuff, stay away from it. What you want to take away from this slide is that the moving averages are coming together. So this wild whippy price action is beginning to come together, where you have more and more traders with a similar opinion are beginning to, that this conflict, this wild conflict, is coming to an end. And this would be probably a good time to look at the daily chart to see where that's at, to get a better bias as to which way this could go. Just the takeaway here is that it's reaching an inflection point where all of those time frames are coming together. And this is a bit of a cleaner one. You can see this is the futures. It applies to anything. And by the way, this is the micro E-mini futures, and I am of the belief that this is going to put a death dagger into the heart of this whole prop trading industry, retail prop trading industry. Because who needs to go take a test and put up $25,000 when you can go open up an account with a few $100 and trade these patterns and make an income day to day? So it's going up, and the red line was facing down for a period of time over here. So it's beginning to bottom out, and take a note of the size of the ranges here. See how it begins to tighten up? Ranges tighten up when there's more certainty about the direction of prices. Ranges are wide on bars and whippy price action when there's uncertainty. So this was a bottoming process. Note that candle right there. That's a sign of a bottoming process. And then a retest. And as things come together and start moving in, multiple time frames moving in one direction, you have fewer big pullbacks. You're going to have to find continuation patterns and, little minor pullbacks as that begins to happen. Everything I'm explaining to you here is about interpreting price action and using moving averages as a visual aid to do that. Do you really need them? Help speed things up. I like it. So, Master Trader, what am I offering you? Well, I can tell you what to do, right? We have newsletters. You can come into our chat room. I'll tell you where to buy, where to sell based on what I see. I have losing trades. Had one today, early in the day. Thought that big gap up, I shorted it, and it went down a little bit and came up again. Anyway, I'm not infallible, that's for sure, but I've lasted 30 years. And you can buy indicators and promises of software. They'll promise to tell you when to buy and sell. It's a fallacy. They'll sell you the next indicator and the next optimized story. Or you can say, show me what to do. I want to do it myself. I think that's what most people want to do, or a combination of the two. And you can do both. Show me what to do. Show me you're doing it, which I'll do in the chat room day to day. I'll show you I do it. My partner Dan will show you he does it. He prefers options. I prefer trading the underlying in a directional way. It all comes down to a method, a trading plan, and money management. Without that, you will fail. And David, I'm going to give me a second here because I took away this link, but I want to just take a second to grab it here. But what I'm going to show you is what our specials for the year. You can decide if you want to take advantage of any of that. Take a look at it. But when you become part of Master Trader, I've developed a lot of these scans that I'm showing you here of these patterns that I look for. And I don't sell them. If you become a member of Master Trader through a newsletter, through the chat room, through a course, and you use this software, which I wish I owned, but I don't, it's fabulous, TC2000, I will give this to you. These combination scans, intraday scans, I have, for 60-minute charts and 5-minute charts. This isn't something that we charge for. We give it away. If you're interested and you use that software, I'll send you a way to just click on layouts and it'll just load it in there for you. Others might sell this for hundreds and hundreds of thousands of dollars, but we'll give it away. And lastly, if you're interested, tomorrow, every Wednesday at 12 noon Eastern, we do what we call MT Live. And tomorrow we'll be talking about creating checklists for your trades. Last week we did continuation patterns. So there's always something educational Wednesdays at 12 o'clock. So you can get on our email list and get the list. You can go to YouTube. It's live on YouTube at that time. I don't have the link right now, but if you email me, Greg@MasterTrader, I will send you the link so you can register and be in the room tomorrow with us, or just watch it on YouTube and at the channel. We're there every morning as well at 9 o'clock, reviewing the broader markets, our open trades, gappers. It's education every day. Dan and I focus on educating our members, whether you're a free or a subscriber or in the room with us, is education every day, because we come from the point of view of we don't want to be reliant on somebody else. It's about being self-reliant. But along the way, everybody needs a way to learn, and that's what we do. So I think my time is up.